What's up guys, welcome to the door number 9 of the finance calendar, where we dive into 24 financial ratios in 24 days. Don't forget to subscribe so you don't miss any of the ratios, and let's go! Yesterday we talked about return on investment, and today we are going to talk about a similar abbreviation, ROE. ROE means a return on equity, and it is calculated by dividing the net income by the shareholders' equity. Let's take Intel as our example again. As with most of the ratios, you can again use the last full year's net income or the trailing 12 months net income. For Intel, the last full year's net income is $20.9 billion and the TTM is $21.1 billion. For shareholders' equity, it is common to use the average of the beginning and the ending of the period. So for 2020, the average would be the beginning of 2020 and the end of 2020 divided by 2. You can find this information on the balance sheet. For Intel, this is $77.5 billion plus $81 billion divided by 2, which equals to $79.25 billion. The return on equity for 2020 is 26.4%. For the trailing 12 months, the shareholders' equity is $85.56 billion, so the return on equity is 24.7%. Intel is actually a great example of why you should use the average shareholders' equity. At the beginning of the TTM period, they only had shareholders' equity of $81 billion, at the end it is already $90 billion. So how can you use the return on equity ratio? As always, you can use it to compare different companies, but it is better to do that for companies in a similar industry. Different industries can have very different returns on equity, so you should compare one company's return on equity to the average return on equity of the industry. Return on equity means the profits that the company is able to make for each dollar from shareholders' equity. So basically, if the ROE is 50%, the company is making $5 of profit for every $10 of equity investments. However, a high return on equity does not automatically mean that the investment is better than ROE just above the average. It could just mean that the company has a very small equity compared to the net income. Small equity could mean more risk, for example when there is a crisis. As always, make sure to use all the available information and ratios before making investment decisions. That's it for today's financial ratio. Hit the like button if you found this video helpful and subscribe so you don't miss the future ratios. Have a great day and I'll see you tomorrow. Bye!